bringing you some of the comments from Richmond Fed President Jeff Lacker and his exclusive interview with my colleague Trish Regan. We want to get some reaction and some insight right now from Ajay Rajadhyaksha. He's the head of interest rates and securitized products research at Barclays. Ajay, thanks for joining us. Lacker told Trish that he expects interest rates to go higher mid-2013. Listen in to exactly how he phrased it.
That's based on my sense that growth is going to pick up enough by then to warrant raising rates in order to keep inflation pressures under control.
Ajay, that's one man on the committee saying that.
Right.
Do you think rates will move higher before 2014?
No, I think that's way too aggressive for a couple of reasons. One is the United States is about to hit a fiscal wall at the end of 2012. At as current law stands, it's about $650 billion of fiscal tightening in 1 year. And if there's anything that Europe has taught us, it's that fiscal austerity does come with near-term drags on economic growth. And the second is the Fed's own reaction function. Remember, the Fed has looked at a US economy that has tried to hit escape velocity 3 or 4 times over the last 3 years, only to sputter out each time. So I have a very hard time seeing the Fed be confident enough to say, you know what, we don't really care what Congress is going to do. We are just going to go ahead and raise rates anyway because the economy is going to be fine, despite all of the challenges facing us.
So that forecast of 3% growth that he foresees, you don't agree with that either?
Our forecast is a little bit lower, but our forecast, more importantly, is contingent on what Congress does. That's actually incredibly important. What we have done over the last 2 to 3 years as a government is we have kept pushing out the fiscal austerity things that are about to come online, and they are all about to come online with a rush at the start of 2013. Now, the thing that worries me is that Congress will probably want to find its way out of some of it. But the way the law is written right now, Congress has to agree on one thing. For example, it has to agree on which triggers in sequestration to try to find a way past. It has to agree on a second thing, a third thing.
Cuts.
That's correct. And this Congress has had a very hard time agreeing on anything. So it's difficult to assume that we'll be able to escape without any fiscal tightening in 2013.
So more and more of a political risk, it sounds like, is what you're seeing. Give me some perspective on what we heard today from the European Central Bank and what we didn't hear from the FOMC yesterday, which was a new round of support for the markets. Sort of do no more, do no less. Is that what they should be doing?
Our base case is that the Fed will probably not do another round of quantitative easing. There are caveats to that, of course, if growth slows down in the second half. If fiscal tightening looms as a very, very serious possibility to a much larger extent that the Fed has penciled in, then again, the risks of another round of quantitative easing go up. But to go back to the European Central Bank, the ECB is in a little bit of a bind right now because the German economy in particular is now for the first time starting to face some wage pressures, at least anecdotally, while the rest of the European Union, especially the southern economy, southern Europe, which really are the ones which have fiscal problems, they are at this point starting to head into another round of at least contraction, if not outright recession in some countries. So it's one monetary policy, but 2 sets of economic realities.
Which countries are you concerned about when you talk about that?
Well, Spain and Italy are the 2 obvious ones. Again, it goes back to the point I made earlier. Both of these countries are facing some fiscal tightening in this year just because of their debt situations. But fiscal tightening does come hand in hand with near-term lags to growth. And that in turn can worsen your fiscal situation even more than if you had not done the initial round of cuts. So it's a very difficult path that the ECB has to, narrow path that the ECB has to walk across right now.
All right, Ajay, we got to leave it there. Thanks for giving us your insight.